Every major financial collapse in history follows the exact same script, yet we fall for the sequel every single time. From the 1929 crash to the 2007 debt peak of 135% of disposable income, the warning signs, easy credit, 10% margins, and pure hubris, are hidden in plain sight. We are obsessed with the idea that our era is unique, but the mathematics of disaster are remarkably simple and completely unforgiving. Visualize the atmosphere of New York City in 1928, where the pavement practically hummed with an unprecedented, electric optimism. In this golden twilight of the Roaring Twenties, the stock ticker became the heartbeat of the nation, with share prices marching upward in a relentless, daily climb that seemed to defy gravity. This was not merely a playground for the elite, it was a fever that infected the common man. Shopkeepers left their counters, teachers looked past their chalkboards, and factory workers stepped off the assembly lines, all unified by a single, dangerous ambition. They were borrowing heavily to stake their claims in the market, absolutely convinced they had stumbled upon a foolproof shortcut to permanent wealth. Prominent economists at the time christened this period the New Era, a term that served as a sophisticated shield against skepticism. Financial experts were loud and unified in their insistence that the dusty, old rules of fiscal gravity no longer applied to this modern world. Yet, this collective delusion reached its expiration date on October 29, 1929. In a single, jarring day of panic, the entire financial architecture collapsed, vaporizing massive fortunes instantly and igniting a global depression that would reshape the economic destiny of an entire generation. What makes this catastrophe truly haunting is that it arrived with a clear trail of breadcrumbs. The wreckage did not materialize out of thin air, the warning signs were flashing brightly for anyone who possessed the courage to look. Instead, even the most brilliant minds in the financial sector chose a comfortable blindness. History shows us that these crashes are not random accidents but rather a recurring theatrical tragedy where the dialogue remains identical, even as the actors and the scenery change with every century. Understanding these cycles requires us to strip away the fantasies of what we hope will happen and examine the cold reality of what actually occurs when credit becomes absurdly easy to obtain. In the lead-up to 1929, American banks abandoned caution, extending loans to virtually anyone with an appetite for stocks. This birthed the era of buying on margin, a high-stakes gamble where an investor provided only 10% of the value up front while borrowing the remaining 90%. Through this mechanism, a mere $1,000 in cash allowed an individual to control $10,000 worth of shares. While the upward swing produced spectacular, life-changing profits, the inevitable downward correction resulted in losses that were nothing short of catastrophic. Easy credit is not a poison in and of itself, but it functions as the high-octane accelerant that transforms a flickering spark into a structural inferno. When credit flows too freely, it sets the stage for a secondary, more lethal warning sign: debt levels that tower precariously over actual income. In the years leading up to the Great Depression, American household debt surged to levels never before witnessed. Families borrowed aggressively not just to speculate on stocks, but to finance a lifestyle of cars and appliances, operating under the dangerous conviction that their future earnings would always grow fast enough to outpace the interest. This same pattern reached a terrifying zenith in 2007, just as the global financial crisis began to brew. During that year, American household debt hit 135% of disposable income, the highest level ever recorded in the history of the nation. The economic logic here is cold and undeniable. When the rate of borrowing exceeds the rate of earning, a breaking point is inevitable. There are only two theoretical exits from this trap: either incomes must skyrocket overnight to close the gap, or the debt becomes unpayable. History shows that the former is a fantasy, while the latter triggers a brutal cascade of defaults, foreclosures, and systemic failures. These mathematics are simple, and they are utterly unforgiving. This leads to the third warning sign, which is the collective delusion that this time is fundamentally different. Before every major collapse, the air is filled with influential voices explaining why traditional metrics of value are dead. During the 1920s, investors ignored the fact that stock prices had no tether to company earnings, blinded by the myth that endless growth had rendered old benchmarks obsolete. We saw this again in the late 1990s dot-com bubble, as billions poured into internet startups that had never generated a cent in profit. Investors convinced themselves that a new economy had been born where profit was purely optional. They acted as if the fundamental laws of economics had been repealed by modern innovation. But those laws have never been repealed, and they never will be. When asset prices detach from underlying value, where a house is no longer priced by what an income can support and a stock is no longer priced by the profit a company produces, the market is no longer creating wealth. This detached price action occurred not because the tulips themselves possessed more utility or inherent worth, but because buyers were trapped in the frantic conviction that they could offload them to a greater fool at an even steeper price. This same psychological contagion propelled Japanese asset prices to surreal heights by 1989. At the peak of that fever, a single square meter of land in the Ginza district of Tokyo carried a higher price tag than an entire city block in Manhattan. Even more staggering was the theoretical valuation of the Imperial Palace grounds, which were estimated to be worth more than the total value of every piece of real estate in the state of California combined. These figures were never reflections of true economic value, they were towering obelisks built to honor a season of collective madness. The fifth red flag is the sudden proliferation of intricate financial instruments that almost no one truly comprehends. Leading up to the 2008 crisis, Wall Street engineered collateralized debt obligations, which were essentially bundles of mortgages sliced, diced, and reassembled into structures so labyrinthine that even the PhD mathematicians who built them could not forecast their behavior under market pressure. This density of complexity served a specific, cynical purpose: it acted as a fog to disguise underlying risk. When those mortgages inevitably began to fail, the entire global system seized up in a stroke because no participant knew which bank held the toxic assets or what they were actually worth. In finance, complexity is almost always a veil used to hide danger until the exit doors are already locked. Finally, the sixth warning sign manifests when the very regulators meant to protect the public are systematically sidelined. Before 1929, stock market manipulation was a legal, everyday occurrence. Operatives could launch false rumors and manufacture artificial demand before dumping their positions on an unsuspecting public. There were no meaningful protections against insider trading or outright fraud. While America constructed robust regulatory walls following the Great Depression, the 2000s saw those defenses systematically dismantled. The Glass-Steagall Act, which had separated commercial banking from risky investment activities for nearly 70 years, was repealed in 1999. The pattern is consistent across every era of fiscal instability. Before every major systemic crisis, the safety guardrails are meticulously removed by the very people who stand to profit from their absence. This leads us to the seventh and final warning sign, which is perhaps the most subtle and psychologically revealing: the systematic silencing of dissent. When those who raise the alarm are dismissed, ridiculed, or ignored, the end is usually near. Before the 1929 crash, the economist Roger Babson explicitly warned that the market was overvalued and dangerously unstable. Rather than being heeded, he was treated as a grim caricature of doom, famously mocked as a canary in a coal mine whose song no one wanted to hear. What makes these cycles truly remarkable is their relentless consistency across centuries and different types of economies. Whether we look at the South Sea bubble of 1720 in Britain, the Panic of 1837 in America, the Long Depression of the 1870s, or the Asian financial crisis of 1997, the trajectories are nearly identical. The warning signs appear in the same sequence because human psychology is the one constant that never changes. We desperately want to believe that prosperity is permanent. We want to trust that the smartest people in the room have everything under control, and we want to think we are living in a special, enlightened moment where the old rules of gravity no longer apply. While understanding these patterns does not grant us the power to predict the exact second a bubble will burst, it does allow us to see the difference between genuine growth fueled by productivity and innovation versus artificial booms built on debt, speculation, and wishful thinking. True wealth finds its foundation only in the tangible creation of goods or the delivery of services that hold genuine value for others. Financial engineering, regardless of how sophisticated or mathematical its design, possesses no inherent power to conjure wealth out of thin air. Instead, it serves merely as a mechanism for redistribution, typically siphoning capital away from those least capable of absorbing losses and channeling it toward those best positioned to shield their interests. This recurring narrative of economic warning signs is essentially a story about human nature and the gravity of incentives. When global systems prioritize and reward short-term thinking, participants naturally pivot their focus toward immediate, fleeting gains. In environments where regulations against fraud and market manipulation are either toothless or entirely unenforced, those very behaviors will inevitably flourish. Furthermore, when debt remains easily accessible and the consequences of overextension appear safely distant, rational individuals will consistently borrow far beyond their means. These outcomes do not require a grand conspiracy or some unusual, concentrated evil. They are simply the result of normal people responding rationally to the incentives placed before them. The modern economic landscape now contains distinct echoes of these historical patterns in ways that would be irresponsible for any serious observer to ignore. Across many developed nations, debt levels have surged to historic highs, and asset prices in various sectors have outpaced the underlying fundamentals that typically support them. Moreover, complex financial instruments continue to occupy a central role in global market stability. These facts do not serve to predict one specific, unavoidable outcome, but they do confirm that the lessons of 1928, 1999, and 2007 remain as relevant as ever. The past serves as a reliable topographical map for navigating the terrain of the present. The most critical lesson is that markets are neither good nor evil. They are simply instruments for coordinating human activity. However, vigilance is non-negotiable because rules are established for specific reasons. Ignored warning signs do not vanish, they compound until the cost of the education becomes impossible to ignore. Every generation is tempted to believe it is special, yet those who believe technology has rendered old laws obsolete eventually pay the full price for that hubris. Identifying the cracks in the foundation is rarely the true obstacle. The real challenge lies in taking those signs seriously when doing so is uncomfortable, unpopular, or unprofitable. One must determine which of these 7 warning signs is most vital to understand before the next cycle completes its turn.